today's video, we're going to be taking a look at some of Chamath's recent comments. Now, with the government printing $1 trillion in stimulus and with more likely on the way, there is the talk of inflation in the air. Many economists and many billionaires and everyone and just about everyone who's actually invested in the economy and is paying attention, right now the big word is inflation. So in today's video, we're going to be taking a look at Chamath's comments, what he said regarding hyperinflation, inflation, and where the US economy is headed next and what you should do as an individual citizen. So if we go onto Twitter, we can see what Chamath has said. He said, "Here's something I learned today. 1979 was peak inflation. It was also when the gap between the rich and the poor was the smallest." Now, this is actually correct. You see, if we look at Investopedia right here, we know that back in 1979, there was huge levels of inflation. It was actually a gruesome inflation as regarded to by Investopedia.com. He then goes on to say it was preceded by a big wealth inequality between rich and poor like today. The solution started in the late 1960s with Lyndon B. Johnson's War on Poverty. By investing aggressively in infrastructure, social programs, and an economic safety net, he evened the starting line. As the poor started to earn more, they spent more, driving commodities and inflation. The rich did less well because the financial assets were worth less. The gap between the rich and the poor closed aggressively. The big realization for me is government spending leads the way, not private capital markets. In the last month, we've decided to spend 1.9 trillion and 3 trillion, which we actually have. So as we know recently, Biden has actually signed and the bill has passed for the 1.9 trillion COVID relief bill. Now, Biden is actually preparing to spend $3 trillion in new spending for the economy. And this is something that you should most certainly take into account when you are looking at the economy. Now, I do want to say that some of these statements may appear quite political, but I do just want to say in the comment section, and from my point of view, I don't want this video to appear any type of political. I'm just focusing on inflation purely. So what does this mean for us, and what does this mean on how it's going to go on in the world? Well, I firstly want to start by saying that what Chamath has said about inflation is quite interesting. This entire thread that he recently posted on Twitter somewhat tries to explain the relations between the 1979 inflation and how things could pan out in today's economic outlook. It clearly states, fast forward to today and the same situation is at hand. Will Biden spend aggressively enough? The early data seems to indicate so, and these initiatives will help poor more than the rich. If inflation does come back, the inequality gap will shrink. Now, of course, we know that the Federal Reserve has targeted a moderate inflation rate because of all the things going on in the economy, but there are some important things to note. When it does come to inflation, one thing that Chamath has actually not got wrong or potentially got wrong, and this is just a factual statement based on data, what people don't understand about inflation is that inflation actually doesn't help the poor people, and this is something that we know from basic economics when inflation actually reduces your purchasing power, which I'll explain in more detail. As a normal citizen who isn't particularly wealthy myself, I do know that the large majority of American citizens that exist right now don't entirely have a huge amount of savings. And even if they do, inflation doesn't help them in the way that people think. You see, what Chamath has said here is that as the poor have started to earn more, they spent more, driving the commodities and inflation. The rich did well less because the financial assets were worth less. However, this isn't exactly true. Inflation actually does quite the opposite. So here's where Chamath is potentially wrong. One thing we can look at is the Cantillon effect. Now, the Cantillon effect is basically, in a nutshell, when new money is created, it doesn't affect all parts of the economic spectrum equally. Increasing the money supply doesn't benefit the average person the same way that it benefits wealthy people. And this is what we just saw with the market. As Richard Cantillon theorized over 3 centuries ago, when a new money is created, it first floods into the hands of those closest to the government, and eventually a few droplets trickle down to the everyday worker. Now, what's crazy about this book that was written so long ago is that it's very relevant to today what we just happened. Now, with the recent Federal Reserve printing trillions of dollars, what did we see and why was it interesting? Well, when they printed these trillions of dollars to help bail out the economy, it wasn't the everyday worker that got it. It was the airlines, the hedge funds, the corporations that got billions and billions of dollars. But many Americans got measly $600 checks. So although it may seem like inflation could help poor people in some aspects, this isn't really what's going to happen, and it isn't going to help poor people as much as you might think. So as we know with average types of inflation or any type of hyperinflation, this is bad for the economy and the average individual. If we look back at the historical periods of inflation, the assets inflate first, then consumer prices inflate, then if ever, wages will inflate. But the majority of what's been happening is that wages actually don't move at the same pace as inflation or the rest of the assets. The assets largely outpace the wages of the wages, and this becomes a problem, leaving more and more people in poverty. So if we pay attention to what's been going on in the economy, and if we look at where inflation levels could be headed, if it does pan out into a bad situation and it gets out of control, we do know that we are headed for a terrible situation. So inflation actually makes the less fortunate even more poorer. And this is very bad. You see, the problem with inflation is that it actually removes your purchasing power. Now, purchasing power is basically how much you can buy with a certain amount of money. The definition of purchasing power is the value of a currency expressed in terms of goods or services that one unit of money can buy. Now, purchasing power is a very important metric because when it comes to inflation, this actually decreases the amount of goods that you're going to be able to purchase. Now, the real problem here is that inflation actually reduces the value of a currency's purchasing power. So what tends to happen over time is that things get more expensive. And what governments do is they try to track this. One way that they try to track this is through the Consumer Price Index, also known as the CPI. So one way to think about purchasing power is to imagine if you made the same salary as your grandfather did 40 years ago. Today, you would need a much greater salary just to maintain the same quality of living. By the same token, a home buyer looking to buy homes 10 years ago in the $300,000 to $350,000 range have more options to consider than people have now. Now, with a consumer price index, this is how they track the levels of inflation. It's a key indicator. And basically, the Consumer Price Index actually examines the weighted average of prices of a basket of consumer goods and services, such as transport, food, and medical care. It's calculated by taking price changes for each item in predetermined baskets of goods and averaging them. Changes in the CPI are used to assess changes associated with the cost of living. The CPI is one of the most frequently used statistics for identifying periods of inflation or deflation. As you can see here on this graph, starting from 1913 to 2019, we can see the average consumer price index has increased substantially. Now, the reason this is bad for poor people and the reason the CPI goes up is, as of course, what we just discussed. Every year, there's going to be more money in circulation, and many different things happen to the economy, and over time, generally, the US dollar value, it just keeps losing it. But as you can see from the graph right here, we can see that there's an average change in CPI, and the average CPI has consistently gone up extremely high since the years 1970 and 1980, where there were some huge levels of inflation. So if we take a look at this article by Property Lines, we can see that it illustrates exactly why buying a house today is much harder than in 1950. A post-war boom, legal discrimination, and new mortgage loans, all challenges for today's housing market. Now, this stuff right here doesn't matter. The point that we're trying to focus on is inflation. And earlier on in the video, I did discuss just exactly the problem with inflation and how it affects the average citizen worse than the average rich person. Now, as you can see here, the median salary is $72,000, but according to a new report, they can afford less than 1% of the homes that are on the market. Now, there are many examples. It says, despite making roughly $18,000 more than their peers in other states, many California teachers, like other basically stating that housing is very, very unaffordable. Now, California, of course, isn't the best example, but this is a widespread problem that you probably have faced yourself. So if we scroll down here, we can see some more information that is going to be much more helpful. So look at this paragraph right here, and this is going to show you exactly why inflation is so bad And why exactly inflation, if it does continue to happen at this exponential rate that it could happen at, things are just going to get worse, way worse for the average American. So according to a rough calculation using federal data, the average teacher salary in 1959 in the Pacific region was more than $5,200 annually, just shy of the national average of $5,306. At that time, the average home in California was $12,788. And then at the 5% interest rate, the mortgage would just cost $59 a month with a $2,500 down payment. If your monthly pay was $433 before taxes, $59 a month wasn't just doable, it was also within the widely accepted definition of sustainable, defined as paying a third of your monthly income for housing. So, referring that to today's market, adjusting for today's dollars, that's a $109,000 home paid for with a salary that's nearly just half that amount. But in today's economy, this is something that isn't as possible. So as you can see right here with this graph, we can see the median home value and the median rent, but the household median income doesn't actually tie to the median home value. So the bottom line when it comes to what Chamath said and when it comes to inflation is that this is pretty much bad for the average person. You see, as it turns out, Chamath is probably wrong to this. Inflation is a regressive tax against the poor, as inflation erodes the purchasing power of the cash base, where majority of low net worth individuals are going to be hosting most of their monetary value. Inflation then drives up the value of hard assets, and the hard assets that we talk about are things that rich people already own in abundance. So as you have more dollars chasing desirable goods, these things are going to go up, but rich people already have this stuff. So right now, this is going to be something that isn't good for the future, but then again, it's anyone's guess as to what happens in the future. The Federal Reserve are always going to be doing many different things, and it's going to be interesting to see exactly what happens regarding inflation. Michael Burry, Ray Dalio, and many other different banks have echoed signs that there may be signs of inflation. However, we're not going to know just yet.